Let's bring in Keith Lerner now of Truist Wealth. Keith, welcome. It's good to see you again.
Yeah, great to be with you.
Cheryl mentions, you heard at the outset, she's a little bit concerned that valuations have gotten stretched. What about you?
Well, no doubt valuations have come up, expectations have come up, but our view is the path of least resistance, at least if we're looking over the next 6 to 12 months, is still higher. If you think about the fourth quarter, that strong momentum that we saw in the fourth quarter, that tends to be a positive when you look out. And when we came into this year, we were extended, we consolidated. During that consolidation that we saw in the first 2 weeks of the year, there was minimal selling pressure, credit markets were well behaved. And then as we broke to a new high, we just did a study that we published on Friday that looked at what happens after you make a record high for the first time in more than a year. And a year later, you're up 13 out of 14 times. Now, to be fair, the one big outlier in that study was 2007. So this is also predicated that we don't go into recession, which is the big debate today. But again, I think the underlying trend is positive, and I think you want to stick with that. And I think there are opportunities. We also put out a note last week saying, we still like tech, we're overweight tech, but on this pullback, we thought small caps, were increasingly attractive, and we're actually like the action today where it bounced off of support, and we're seeing some of that rotation follow through today.
Yeah, no, your point's well taken. Russell today's up 1.5%, so it's the leader by far. History's one thing, right? When we look back and we say, well, when the market does this, it often does that. We still have to justify, though, these valuations, don't we?
Certainly, yeah. I mean, I think Warren Buffett said if the only thing you needed was history, the richest people would be librarians. But I think it is a good starting point to say, hey, are new highs a good or bad thing? And then you stack on other things. So, sentiment is somewhat extended, as mentioned. Valuations is a curious thing. And it's you look at the broad market, certainly expensive around 20 times. If you look at the equal weight, the average stock, you're around the average, just below 16 times. And if you're saying the market is expensive, then you're making a bet that the Mag 7 and others will come down. I'm not, I don't have conviction in that call saying that the Mag 7 is going to come down. So if I look at the overall market, maybe that moderates how much upside you can get. But I think the trend is still higher, and I think you want to respect that.
What do you think?
I will say this on the valuations. While this market definitely probably has some legs, I just don't see we're going to have the same kind of returns we had last year. I think it's going to be more muted. So I think there's some upside, but I think you have to be a little bit cautious. And sentiment, he alluded to sentiment, which I very much respect his work. I listen to Keith actually quite a lot. Sentiment has been really, really good at predicting greed and fear. And so when sentiment is high, I actually get nervous. So not to play devil's advocate here, but the fact that sentiment is high actually makes me a little bit nervous.
Yeah, no, your point's well taken too, right, Keith, that when everybody was seemingly bearish, we had this rip-roar rally, and, kind of people were a little slow to make the transition, but now it feels like everybody's getting all bulled up except for a few outliers. Is that concerning that we have many more people on the same side of the boat now than we did?
Yeah, and just to clarify the position, I do think sentiment is becoming more of a headwind as opposed to a tailwind. But when you look at the overall market, I think you still have to focus on the underlying trend. Forward earning estimates have just reached another record high this week, or last week, I should say. Credit markets are there. So I do think, if you say what's one of the risks, or why could we, go back to a choppy fashion, it's because that sentiment's becoming somewhat, more extended. But listen, sentiment is important, but I would say the trend trumps that as far as the fundamental earnings, the economy, and the direction of inflation. So I think the way you use sentiment this year is when it starts getting to an extreme. And in our work, we're not at that extreme yet on the upside. We could use that to trim positions or add to positions. But again, I don't think that's enough to overwhelm the weight of the evidence that we just discussed.